I second that. I particularly second much of what Andrew said. I want to go back, though, to the opening question and the raising of Pew, because Pew is a very good example of what is going on. Pew, for those of you who don't know it, is a multifaceted organization. We are most aware of it as Pew, the research organization. Recently, Pew, the research organization, interviewed 137,000 people about their religious habits. The Pew that is issuing pronouncements about lending in the small dollar sector is Pew, an advocacy group that hires lobbyists and has a point of view that they cleverly put away for a while. That is to say, when I would go to meetings with one of their spokesmen, I would have to point out to the audience, this is not Pew, the research group. Their piece of research represented 437 people being interviewed by phone about things they did over 5 years. Their conclusion was that Payday, a mono payment thing, was not a good product. But their research would not pass by anyone in terms of peer review. They have had an inordinate amount of influence with the Bureau, whose own research is shoddy, to say the least. You got a glimpse of that with the look at what they did on auto financing. But you have only to let me give you an example that I run into as we get our comment letter prepared. In effect, banks, because of the regulators, were moved out of payday lending. So someone at the CFPB had the brilliant idea that they would go and take the customers who had once been payday lending customers in a bank and follow what happened to them. And remarkably, they came to the conclusion that once they were no longer payday borrowers, they didn't have any difference in bankruptcies, no difference in their credit report, no problems with payments of loans. They also found out, but never disclosed in their research, that those customers went to payday loans online. They did not allow any of us to see that. We stumbled upon it by accident. It is not honest research when you do that. Not honest research when you publish a white paper which is truncated to make the results look worse than they actually are. Their research is flimsy to non-existent in terms of peer review. Their research is designed to buttress their conclusions already arrived at. That's a major problem, and their allies often have conflicts of interest with this. Beyond all that, though, and beyond the research question, I take Andrew's point. There are many people there who had no particular interest in cutting off credit and who are doing the Lord's work in terms of what they think. But they are oblivious to what the customer is. I remember going in my first interview over at CFPB after I took this job and talking with them, and they said, we're not really convinced that this is a demand-driven product. It just may be that because the supply is out there, people are availing themselves of it. And all you have to do to disprove that is look at the profiles of the people who are borrowing, something they have never troubled to do. I find it incredible that they move toward, as Bill is saying, they move toward encompassing other products when they came to believe that payday lenders would move into installment lending and, in their terms, bring the same kinds of practices that they don't like. Therefore, they thought it wise to bring everything under one net. Now, the fact is that they had spent nearly 4 years examining payday lending, and I give them that they know something about it after a 4-year study, although they approached the subject with great bias and never got away from that. But they know next to nothing about installment lending, next to nothing about title lending. And if you just compare the amount of time they spent on payday versus those other two products, you know that they couldn't have done the same kind of analysis. And we don't find the analysis, of course, on payday anything that's compelling. But they moved toward this not because they were consumer-oriented, but because they really are oriented to do away with certain kinds of products that they deem not to be the kind of product they want. I'll give you a further example of their mentality. They realize that under the Mortgage Act, that they have passed, it's virtually impossible to get a mortgage as a person who might want one in a $75,000 to $100,000 home in target cities across the country. They planted an article in the New York Times that said, in an effort to get around our mortgage rule, people in this bracket, 75 to 100,000, are looking toward land leases and other forms to get financing. It evidently never occurred to them that since financing wasn't any longer available in the mortgage market, people who were buyers would seek other methods to get that. The parallel here is they have no knowledge or willingness to admit that there actually are, by much research, more payday loans given illegally by unregulated entities than there are payday loans given by regulated entities. The first meeting I had with them, I also said, what are you going to do about unregulated entities that dispense payday loans? We're going to get to that. They haven't gotten to it in 5 years. This is a problem they don't want to face. They are not acquainted in a sophisticated way with the many differences in payday lending. There's payday lending by store. There's payday lending online. There's tribal lending. There's lending by entities that have codes of best practices. There's payday lending by people out there who have never seen a regulator, never registered, and are absolutely the court of last resort for people who are unable any longer to get regulated payday loans. This whole episode demonstrates one thing, that there is a class issue here. Those people in the Bureau, many of them well-meaning, have absolutely no acquaintance with people who need $250 to $350 and for whom it is a lifeline. And because that's true, they can't place themselves in any way in the customer's position. And because that's true, it is of no great consequence to them if the product of their action is to take away that credit source. I've actually heard people over there say, well, there are a lot of people who simply don't deserve credit. Now, it's one thing if a bank says to a customer, you don't deserve credit, or a payday loan entity says you don't deserve credit. It's a very different thing when a government agency says, here's a class of people who don't deserve credit. Let's not bother to go through the business of analyzing them one by one. It is more efficient administratively and much easier for us if we just put them in a single bucket and say, no credit to you. That's exactly what's going on. And I'd add one further thing for anyone who's interested in free enterprise in this country. Where do these people think they want to go? The post office, the community development grants, special points for banks who might move back into this sector. They see the solution to problems in this area if they arise, and they're very reluctant to have them, to acknowledge they will arise. They see the solution as one that will be governmental. That is a specific problem that we all ought to be concerned about, because it implies that credit issues should be handled at the federal government level. Imagine handing your private papers over to the post office in an effort to determine whether or not you can get $250. It's mind-boggling.
Thank you, Dennis.